I don't think it just gets stuck in this feedback loop where it can't get back down to peg and it mints forever.
To me, it goes back to like a core idea though, which is, do we want the system to mint to attract new people? Do we want the minting to be the thing that attracts new people, or do we want the stability to be the thing that attracts new people? Like, to me, this is an existential question about where the demand comes from.
I would make the argument that the minting is the only way to attract new people. If you want stability, you should buy DAI or USDC.
But it's the stability with the potential for yield in the future. Like that to me does feel compelling versus, yield right now, you really are getting a different buyer, I found.
You're getting a different what? I couldn't hear that last word.
A different buyer. The demand you're going to get is different in nature.
But the problem is you have the chicken and egg problem. Like, the egg is the prince and the chicken is the stability. It's not stable until it's going to be, it's not going to be more stable until it's going to be a lot bigger. So people are not going to view this as a stable place to allocate their capital until it's already proven that over time. But it's not going to prove that over time until it becomes stable. So you're not going to make it there without some other incentive. And to me, that other incentive is, prince.
Well, this is exactly why I feel like it's so important that we call a spade, right? Where we, like, to me, for me, the belief has always been that the protocol can create stability, or relative stability strong enough that could create demand. But maybe that's not true.
Ben, I guess I'd like to understand what you imagine the incentive for silo participants at scale to be in the system is. At 10 billion, let's say 10 billion is the amount of stables that the industry really needs that are not available. And so we kind of reach that capacity. And then what happens to the silo participants?
Well, I don't know if I accept the premise of the question, because theoretically, if Pinto is adopted, we expect it to be used for economic activity. And that economic activity will likely be value creative. So in an optimal setting, the way the Pinto economy should work is that borrowers are able to borrow Pinto from the silo directly, which in some sense is borrowing from the depositors themselves, in order to create things of new value, and will pay to the silo some yield for the right to borrow the Pinto. So even if we assume no new need for an increase in the monetary base, there should still be yield flowing to silo depositors in the form of some cut of the value that's being created through the Pinto economy. But separately, the growth of the Pinto economy would likely also lead to an increase in the optimal amount of base currency available, such that there would also be an increase in yield from minting, as opposed to just yield being paid for borrow.
I can't contest it.
I wanna add to that the silo attracts liquidity. We expect to generate some yield from that liquidity, whether it's trading fees or lending, maybe in the future perps, whatever it is, however way we use that liquidity to generate income or revenue is going to be the purpose of that silo participants, including creating all of that revenue through stability, which is converts and all of that. They are able, or we are able, to create the stable currency, and then we're using it for all of these revenue generating activities that today we don't really have it. You can argue the only thing that we have is trading fees, but we also electively chose to remove that too. So Where we stand right now, it's pure speculation, but obviously when we're at like $1 billion or more, or even if we choose, next year at a smaller volume, we should be able to create some revenue from whatever liquidity we have.
I just have the belief that as soon as you get into the game where we're trying to attract new users through mints, immediately the best way to do that is to have some baseline minting conditions. Like if we're within a certain price, we're going to mint. And it may be that we're within a certain price for a certain time, we're going to mint. But that to me feels like a better way to respond to the thesis that Ford Pinto is putting forward, which is that, in order to attract mints, or in order to attract new depositors, we need mints. It's like, great, well, then just do that. Just mint. Why are we going to create this like long-winded way to maybe create mints if the thesis is that we actually just need mints? Now, I would say I don't subscribe to the thesis that we need mints. But if we're going to move forward under that thesis, we should explicitly acknowledge that that's our thesis, and then to act accordingly to that thesis. I think it's very different than this stock convert penalty. I think the stock convert penalty has merits because of what NATO said. NATO, I'm still struggling with that one.
Game every time, man.
Amazing. Eventually we'll be there. So that's the deal on my end.
Yeah, the thought has crossed my mind before that if the system is totally at peg, within like, I don't know, call it plus or minus like 1,000 of peg, or at least, within plus 1,000 or something, then there should be like a congratulatory mint, of like that averages out to some small number, like 3 or 5% per year.
Congratulatory mint.
Like, congrats, guys, we're at peg. Let's just let the system, let's celebrate by giving everyone a cookie.
Sure, but can you see how that is a totally different philosophy than what is currently underlying the system?
Yeah, but I certainly agree, and I would argue that the current philosophy underlying the system is not going to work. Like, you're going to have some. You have to have some mint, within some reasonable amount of time in order to grow the system. Like, I think as the system gets bigger, you can reduce that potentially.
Really? My
Reduce.
concern is it's like an addiction, like if the system grows from 10 million to 1 billion with some yield that comes when we're within a range of peg, hard to imagine ever feeling comfortable taking away that, that drug.
Yeah, I mean, and if the drug is working, then perhaps you could keep using it.
Now you got us hooked on Ozempic, man. But I'm skinny.
I mean, Ben, you said, you feel like the protocol is optimizing for stability, and the economic activity on top of Pinto is what generates the yield. It's hard to imagine any economic
I
activity.
said that at scale. I was asked a very specific question about how it works at scale, where there's no increase in the supply of Pinto.
Well, how do we
How
get
does
from
this
here?
feel? Yeah.
Like this bootstrapping phase is the hardest part, I feel like.
The bootstrapping phase is the phase where there's the opportunity to make a fuck ton of money. Like, I don't think the protocol really has to, compromise. This is maybe the exact point. Like, now is the time where there is the most return for accepting the risk of participating in the protocol before it's been widely adopted. Like, now is actually the time where the risk return of staying, and participating even when the system isn't directly minting makes the most sense. like now is when it's the easiest. So I totally agree. Like, it's way harder. I mean, yeah, maybe I guess I disagree that the bootstrap is when it's harder to get people to participate. It's like, no, this is when it should be way easier because if you're
Let me
right,
finish this call. And then
I'm sorry.
I think he was accidentally unmuted.
So yeah, I mean, from where I sit, it's much more dangerous now, to make that trade now. Uh, this is sort of the anchor dynamic that played out with Terra Luna, where it's like, yeah, would the protocol be able to support a 20% artificial base yield right now? Like almost certainly. What would be the effect of that 20% base yield? Like almost certainly there would be a fuck ton of demand for the protocol and for the currency. And I would expect the demand for Pinto to skyrocket into the 9 figures, 10 figures. It would get pretty big pretty fast, hang out 20%. But as soon as there's a DPEG, um, I have a feeling the whole thing would pretty much blow up. And it would blow up because it was growing inorganically. It was growing from mints that there was an actual demand for Pinto at that risk return profile. So I think it's quite a scary trade-off space to be in, where it's like, we're gonna sacrifice the longevity of the protocol for mints in the short term. Like that's a trade-off space. I don't feel great about operating it.
I should clarify, I'm not at all advocating for like a base yield, nor am I advocating for like trying to artificially, like just make it pump like as soon as you cross a little bit. It's more of like just letting the system breathe. Like I think about it in terms of momentum. Like the system gets momentum going up and the system gets momentum going down. And you have to be able to flip between these two pretty efficiently. So now we're pretty good at getting the downward momentum because we can convert down. We're not as good at getting the upward momentum, I would say. And I think part of the reason that we're not as good at getting that upward momentum is because it's so easy to get the downward momentum. Everyone knows that as soon as we get over peg, it's likely that a bunch of people are going to convert straight into LP, and we can look and see what the L2SR ratio is, the amount of pure Pinto in the system. Know that there's approximately 4 million of pure Pinto that can convert down. But if we look back to the previous iteration of this experiment, Beanstalk, I believe at the time that the system started growing again, the L2SR was something like 5%. So there was a massive amount of pure bean in the system, and yet those people did not convert down. Likely, I think, because it was not even a feature at the time. Like you could only convert into ETH or something, was my understanding. So people preferred kind of the idea of it being not less exposed to ETH, even though in practice it actually is fully exposed to ETH underneath. But point being, I think one of the reasons that Beanstalk got out of that very low L2SR high debt state was because people could not convert down. And so when the print started, then they kept snowballing and growing. And that was a way that it got out of the debt. Like sooner or later, you're going to have to print to pay off the debt. And so letting the system breathe so that it can get to the point where you can get the momentum building is more the idea. And for sure, after X number of hours of being over peg, you can convert down, and that should never go away. But yeah, that's more of the thesis.
I mean, for me, like the argument that we're creating the base yield, I feel like, on this convert spec, this, specific implementation where you're still allowed to convert. we're just adding friction to it, and little friction if you have no Chrome stack at all. Like if everybody converted their earned Pinto immediately after peg, that is still currently possible under this spec, from my understanding, without any penalty. So I don't see it as binary, as just like letting the system print, from my perspective.
What is still possible? I didn't understand that.
If everybody converted, we mint such the system mints delta p such that if everybody were to dump a delta p, it would go down. I'm saying everybody is still able to convert their earned Pinto immediately after they get it, without any penalty.
Totally.
Not only convert, but they can also just dump it as well. And plus, I should note that 50% of the mints go to the field, and the field has absolutely no restrictions. They can also dump their mints as well. So there's still quite a good amount of downward pressure when we cross peg. It's more of like letting up that foot that's on the neck of the system slightly.
So your argument, just to understand it, is that the conversions downward are actually net negative.
Yes, at least until you get momentum built again, then they become net positive. Like, can we get on the same page about like the system needs to grow over over a long period of time? The system needs to grow, correct?
What does it mean needs to?
So, for example, let's say if I go to the data chart here, let me just pull it up so I can use actual real numbers as a better example. If I click on the Pinto supply, go to all time. Our all-time Pinto supply topped out at 8 million, right? Now it's at 11 million. So the system has pulled approximately 7 million Pinto off the market, and the cost of doing so is a pod line of 32 million. Okay, so right now the system is paying 32 divided by 7, paying 4.5 future Pinto for every Pinto that it's pulled off the market, and the system has not theoretically bottomed out yet because we're not in a growth phase at the moment. So that means that and plus we have only lost let's see, what is the percent of supply if we did in those terms. So 17 or 18 divided by 11, or I guess it should be the other way, or it should be 7 divided by 18. So 38% of the supply we've pulled off the market, but it's cost what did I say, like four pods per Pinto in order to do that. And so if we need to pull another 38% supply off of the market, because if the system is not growing, the pod line is just going to keep growing at an extremely high rate. And I would argue that the longer the pod line and the higher the temperature, that is the system's death spiral. Like, this system dies when the pod line is so long that people don't think it's going to get paid back. And so sooner or later, the system has to grow again and has to start paying off its debt in order to be viable over the long term. Do you agree with that?
Well, generally, yes. But if we think about this in like a true like cyclicality, there is some like minimum demand for Pinto at the moment. And the Pinto demand is like, it seems like the market cap continues to hang out around 9.5 million. And I understand it's not a perfect proxy for actual demand for Pinto, but you kind of look at those numbers and you could say that the protocol probably has to remove another 2 million
Pinto from the supply in order to be at a point where the demand is in line, or the supply is in line with the demand for Pinto.
How did you come up with that 2 million number?
Well, the market cap continues to hang out around 9 million. And the supply is around 11 million. So, if we were going to make up a number, and it is made up, I could see another 2 million coming off the market, and then maybe finding an ability to stay closer to peg more often. And given the protocol's already been able to remove 7 million from the market, I feel like 2 million is quite reasonable. A number that was thrown out previously was that we would need 4 million of demand, excess demand above peg to start prints. To me, that number is more questionable. But even if we granted, like, we need 4 million of demand, I'm guessing that comes from like like we have like an 11 million Pinto supply, like 4 million of liquidity or something. So the assumption is that like we need half of that excess Pinto over liquidity to be eaten up somehow. Like, to me, I think it's much less likely that the protocol has to borrow 4 to 8 million Pinto from the market in order to grow again or be in a position to grow again, which to me, it's like the healthiest way to start this cycle is when there actually is excess demand. Like, the minting should start in earnest when there is excess demand. So, the point you're making about does the amount of pods issued at the moment in order to remove 7 million from the supply, is that sustainable? And it's like, let's say the system grows to 100 million, pays off its current debt, and now the next cycle has to borrow 50 million from the market. Like, I fucking hope it doesn't have to pay 4.5 to 1 to remove 50 million from the supply. That could get pretty expensive, issuing 250 million pods. But I don't, like, to me, the circumstance that you're talking about is sort of contingent on that people are not willing to lend Pinto to the protocol, and I don't think we've seen that yet. So it's just there's so many different things at play here, or so many different elements at play. I'm just not so sure that it's reasonable to say, like, unless we implement some penalty such that printing doesn't happen, or printing starts to happen shortly after we cross peg, even if it could not happen because of converts of new mints and people selling, from where I sit, it's like it really does feel, and I appreciate your point that why can't two things be true at once, but to me it does feel like a real shift in philosophy around why are we printing? Are we printing just because we think that if we don't print the thing's going to die, or are we printing because there are no sellers or converters, and we're above $1? Like, historically we've only printed because of the latter, and this generally feels like a philosophical change to me around printing when we're not, when we need a little juice.
So in your ideal scenario of how the protocol works from here going forwards, you would say that based on the difference between this is an interesting concept. The first time that I've heard this difference between, like, so the current Pinto supply is 11.1 million. The current market cap is 9.4 in dollar terms, which is because Pinto is trading at 84 cents, which is so this 2 million difference that you get, or almost 2 million difference, is very different than the delta P, which is only minus 289,000. It almost sounds to me like you've come up with another metric to determine what the difference is in the supply overhang. This is really interesting to me. I think we should dig into it a little bit. Can you talk to me about that? Like, why is that? Is that a more valid measure than delta B, or why is that worth mentioning?
Well, first I would say we don't really use delta B for almost anything at this point. Like even with the latest change in soil issuance, like we just use it as a proxy and then we totally like manipulate that value. So I don't know if it's even fair to say like delta B is so enshrined, particularly from a like uh a practice perspective. Um at the same time, it's like the protocol needs some way to estimate how much how many Pinto to remove from the market. And I think the metric that I'm sort of putting forward here is not something that the protocol should be operating off of in any sense. Like we don't know if the protocol for it to say like, it's going to borrow 2 million Pinto from the market right now would be incredibly aggressive in the sense that the protocol wants to borrow as little as possible. And so it may be like if you're looking at it from the like 100,000 feet or something, it may be that in the long run, we're going to need the supply to come down to like 9 million or so before we get to a place where there's actually excess demand and we can have printing as a result of excess demand. But that definitely feels like it could be the case. At the same time, it is sort of made up because, of course, in practice, delta B is the right metric in terms of how much demand would we need in order to repeg the price. But it's like repeg the price in the pool itself, assuming no value comes in or out. And then, of course, you also have to lay on the additional complexity that comes from the fact that the value of the liquidity pool tokens is also changing. So I don't know if what I'm really proposing is like a new metric that the protocol should consider. In fact, I think it's almost certainly not. That like it doesn't seem like it's going to get us a better metric in terms of like order of magnitude of what the system should be trying to do, particularly given like the latest updates to the soil issuance, where we're issuing it just significantly less soil than even delta B. And this number is always going to be bigger than delta B. But I think it is helpful, from a mental model perspective of like, is the system in a supply growth or a supply shrinking phase? It's like, well, we've seen the market cap come down into the 9 million range or so multiple times over the past couple weeks. There seems to be some support at the 9 million mark. And again, open question as to whether that mark is maintained if the crypto market fell out another 30%. Maybe we go down to 7 million or something of market cap. And that would mean maybe a change in how many beans or Pinto the protocol needs to remove from the supply. But I think at a high level, like, why isn't the system printing right now? It's like, well, the market cap is consistently 10 or 15% below the supply. So clearly there's a need to remove Pinto from the supply. And, there are two ways that the protocol can really do that. One is through borrowing and burning, which has worked on the order of 7 million so far. And the other is through converts, which, we've talked about a convert bonus, which has a lot of potential, I think. In terms of getting the depositors to act. Now we're talking about a convert penalty for converting down, which I think has a lot of potential to minimize the extent to which people act. But where I take issue is I think, disincentivizing people from acting is a step that really has never been taken before. Where or at least it's a step that's never been taken before in the context of the protocol really does want to oscillate above and below peg and is not optimized to mint. This would be the first time where the incentives that are being created are designed to actually mint. The protocol is now taking an opinionated view on minting itself. So to me, it is quite a significant change. I know it's a long and winded answer, a long and windy answer there, but a very complex topic.
I mean, do you think the protocol right now is optimized to issue pods?
What do you mean? Is it optimized to issue pods?
Like you're saying the protocol is taking a neutral stance. But I think going back to like Nato's point or not those in the beginning, it doesn't seem that's the case. It seems to be the stance is not neutral. It's leaning towards below the target at the moment with the current incentives.
Well, there's a difference between the mechanism being such that it is likely to spend more time slightly below peg versus slightly above target, excuse me, not peg, and being optimized to issue bots. Like, there's a difference. There's an open question as to when the system wants to repeg. Does it prefer to issue debt, or does it prefer to compromise on liquidity? I think that's generally a pretty open question. And one of the things that the model should, I think, get a lot more refined at is being able to pick and choose whether or not it wants to make a trade-off in terms of debt or trade-off in terms of liquidity. This is before the conclusion of the state cases discussion I had a while back. But that is, to me, a different question than does the protocol want to mint or not? Does the protocol want to create a new demand for it? Like, whether or not to compromise liquidity or compromise on debt level, that is an open question. That's a totally separate question in my mind from should the protocol be minting to create new demand.
Well, like as of now, the protocol is minting soil to incite demand, right? So it's kind of like, well, like I guess maybe I'm not really explaining myself properly, but whether or not the protocol is minting more to incite demand or minting soil, I feel like each of them has their upsides and downsides, and it just feels like at the moment, this avenue of using more prints to incite more demand is like hasn't been explored, which I guess goes back to the original point of should it be done under fork or something.
Well, the problem to me is that the demand, like printing, I really do view it as a drug from the protocol's perspective. Like, right now, if the protocol wants to sacrifice pods or sacrifice liquidity, there's some very clear trade-off that is being made in terms of the health of the protocol, but the health in exchange for the price, where it's like, obviously the protocol would prefer more liquidity over less liquidity, and the protocol would prefer less debt over more debt, but it ultimately wants to return the price to its target. And so it has to trade either liquidity or debt for price. Like, that's a trade that the system can make. And, there's a point at which people are not going to be willing to make that trade with it anymore. But I think we are pretty far from that place. But that's a trade that I think is reasonable to make. Versus the dynamic that's created when the system is just minting. The system is just continuously minting in order to create more demand, such that it actually doesn't need to issue more debt and it doesn't need to sacrifice its liquidity. It can just mint, and it can mint as a solution to all of its problems. To me, that is a pretty different dynamic, to say the least, where the dynamic that's created is one where all of the demand, which at some point, if the demand leaves, it means that the system is going to have to create a lot more debt and sacrifice a lot more liquidity to make up for that outflow of demand, that the demand that is generated is coming because of the minting itself. And, if the demand is only there because of the minting in the first place, then really the only way to sustain that demand is to keep minting. And you're going to keep minting, then at some point sort of end, a bit of a deal with the devil, where the only way to keep the system alive is to keep printing. But if you're gonna keep printing, the demand for the system has to increase in line with the printing. And this is the problem that Terra ultimately found itself in, independent of the fact that the model that they were using was not scalable, a la credit. They were able to, create an artificial demand on the order of tens of billions of dollars. And, you can totally do that again. But to me, that doesn't feel very sustainable, in the slightest. Like, it'll work until it doesn't work,
I would argue that this is the exact position that Pinto is in. Like, this system only works as long as over the long horizon there is increasing demand, because the cost of removing a Pinto from the market is greater than the cost of adding it back. Like, because the temperature is always going to be greater than zero. Therefore, you can't round trip a market capitalization. For example, let's say you go from 10 million to 20 million back to 10 million. Each time you do that over and over is just relying on the fact that people are betting in the future that the market cap is going to reach an increasing number. Therefore, the system requires, over a long period of time, growth. So it's not really, in that sense, in any better of a position than Terra was, because it requires this future speculation of growth. Isn't that the case, or do you view things differently?
Well, I must confess I lost a little bit of what you were saying because my food delivery is coming.
I can repeat. Let me know if you're in a good spot to listen. Are you there, Ben?
Can you hear me?
Yes.
Mhm.
Are you in a good spot again?
Well, I was always in a good spot, but my food delivery guy has called me like 15 times, so it kept kind of glitching out. But thankfully, someone is now helping me with that. So the point is, I can't say I heard you entirely, but I believe, maybe to restate what I believe you asked was, isn't the system in the same place as Terra, regardless, in the sense that it needs like perpetual demand in order to sustain itself? I didn't exactly understand the back and forth part of your question. Like, if the system grows to a certain and like regresses, maybe it would be helpful if you restated that.
Yeah. Let me restate. So imagine we're at 10 million market cap now. We go up to 20, right? Very easy, because the system can print. It costs the system basically nothing to print Pinto. Then we demand leaves for some reason, and the system needs to go back to a point where the market cap is back to 10 million again. So in order to do that, it has to issue these pods, which is this debt. And in order to do that, it issues them at an increasing temperature, which results in a longer and longer pod line. And because the temperature is always going to be greater than 1%, as in you don't have negative temperature, therefore there's always a cost of, it costs more than one Pinto to pull a Pinto off the market, if that makes sense. And so for any round trip you do in market cap, let's say then you go from 10 to 20 back to 10 again, and you do that again and again and again. Each cycle you do that has an increasing cost to the system, because it requires that people are betting that there's going to be, that at some point the system is going to reach a higher and higher and higher market cap. And it always requires that people agree to bet that the system is reaching an ever-growing market cap in the future, there's no point at which this theoretical market cap that the system is going to hit decreases, because the amount of debt is always over the long term is always increasing. Does that make sense? Or do you agree with that
Well,
thesis?
all right, can you hear me?
Yeah.
Hold on, I can't hear you now. I have a feeling my food is never making it to the 13th floor. Okay. So, in some sense, you are correct. The protocol can only sustain itself if people are willing to lend to it. And by the nature of the loans, no one in their right mind would sow a bean for less than one pot, or sow a pinto for less than one pot. And so there is some notion of, if the protocol is going to be able to attract lenders, the ability to attract lenders is sort of contingent on the idea of the expectation of future growth. However, the dynamic that you laid out, where every time you round trip, you're issuing more debt, and therefore it's only going to happen at a higher temperature, and therefore, that doesn't seem sustainable. It's like, well, in some sense, that's totally true. Round tripping from 10 million to a billion back to 10 million, hard to imagine the protocol is going to be able to remove 990 million Pinto from the supply under any circumstances, given that it's a 99% drawdown in demand. Like, hard to imagine people view that as sustainable. So there's definitely that component of it, where, to me, the way the logic cuts here, though, is totally different, which is, therefore, this is all the more reason to minimize the extent of the oscillations in demand, like aggregate demand. So it's much healthier for the system to go from 10 to 20 million, and then from 20 million down to 5 million. From 20 million down 5 million to 15 million, and then from 15 million up to 30 million, and then from 30 million down to 20 million. Than it is to go from 10 million to 30 million to 15 million. And the reason why is that at each of these cycles, getting in the back of the pod line does become increasingly harder the further the deviation from the peak market cap is. Because it's like, well, there is some multiple on the premium that the protocol has to pay in order to attract lenders. And the lending is sort of, in that sense, a bet that the future supply will go higher than the previous high. So the further we are from the high, obviously the more that will require a premium to be paid by the protocol, if that makes sense.
Absolutely. So you're basically in agreement that the protocol requires growth over the long periods of time.
Well, it requires growth, is the point. It requires, and not just growth in demand to hold the currency because it's paying you some dividend in perpetuity, a la Anchor, but it's growth in the demand to hold the currency because it's a great currency. Like, to me, those are really different value propositions.
And I think, to me, the point I want to pick apart in regards to what you said was, in the long term, like, where Pinto differs from Terra and its ability to withstand decreases in demand in the short term But in the long term, any fiat system, is predicated on the fact that the demand for the currency will increase. Like the US government issuing debt, an interest rate greater than zero is the exact same thing. It's the expectation that over time the supply will increase and, therefore they'll be able to pay off the debt that they're issuing now in the future. So I don't know how you could, like, I feel like the whole concept of, a fiat system is predicated on the fact that in the long term you will have inflation of the supply.
Awesome, awesome. So with that in mind, what do you see happening that triggers the next growth cycle? Like, is it really just that people sow enough Pinto? The pod line gets super long. Let's say people sow 2 million more Pinto. And if they do that at the current, 8x return, then that would add 16 million pods to the existing pod line, which is currently 32 million long. So that would give us like approximately 50 million length of pod line with a market cap of now we're at 11 million Pinto. So if we withdrew 2, then that would have a market cap of 9 million. So that's a 5x amount of debt for every outstanding pod, which would be, I guess, a 500% pod rate. Is that what you see playing out here in the future?
Well,
is
personally, go ahead.
I know I'm asking you to make like kind of like what do you think is going to happen kind of a thing, and obviously no one knows what's going to happen because of an experiment. But I'm just curious, like what the ideal scenario is for how these cycles play out. Like what's the theoretical goal of the system, and like what is the system optimizing for around how these cycles work?
Well, first, I do want to say I have no idea what's going to happen. So someone could ape in $2 million tomorrow, and that'd be great. No need to go down to 9 million market cap or 7 million market cap. Who knows? The question you ask about what does the system want? How does it want this to go down? Is really interesting. Ironically, what it wants is, in some sense, to grow slowly and steadily, where in practice there would be some consistent demand that would lead to some stable, low amount of yield. But it would want the feedback loop to be started organically. In practice, and I mean started organically as opposed to just because the protocol started to print. You could say, what's the difference? It's like, well, there is actually a world of difference of what was the Kickstarter for this, for the growth cycle. Now, in practice, that's not really realistic. So the protocol actually ends up growing in real cycles, as we've observed time and time again. And so the big open question is, how big are the cycles? Can the system handle such large cycles? And, is there a way to make the cycles smaller? So in some sense, it's like, I don't know if the system has a preference other than like the smallest cycles possible are just this consistent growth, where in practice there's no cycles. In reality, there is some cyclicality. And so the protocol has a preference for smaller cycles, where in each cycle we have an opportunity to get really good data about what part of the cycles didn't happen optimally. Maybe there was too much minting. Maybe the temperature went up too fast. Maybe there wasn't enough incentive to convert. Maybe there was too much incentive to convert. So the optimal setup here is smaller cycles where the protocol, if the protocol grew to $10 billion in short order, like, is that really healthy for the long-term growth of the system when it only had one opportunity to pay off its debt, from 10 to 100 million? Like,
maybe, but it's probably much better off if it's able to pay off debt all the way up to 10 billion, and it's paid off billions of dollars of debt by the time we're at 10 billion, so that it's way more likely to be able to borrow billions of dollars next time around.
So what do you see as the triggering factor between the oscillations of the cycle? Like, I think on the upside, it's just people taking profit. But on the downside, what do you see as like the trigger to get the next cycle going again?
Well, I think we need to see an extended period of time where the protocol is actually oscillating at its price target before we can really have another big growth cycle. So I don't, it's like catalyst to grow. How about just fucking work first? And then we'll go from there. So right now we're chilling at 84 cents. It's like, I think a lot more needs to happen to get there, to get the protocol to a place where it's healthy enough to, warrant growing to the extent that it should grow. Like, it's at 84 cents. It's in no position to grow from where I sit.
But would you agree that over time, as the protocol sits below peg, it continues to get into a more and more unhealthy state as both the temperature and the pod line increase?
No, I don't. Personally, I don't subscribe to that. I think there is some notion of that occurring, certainly, in the sense that, like, like that it will no longer attract lenders. But in my mind, it's like right now, all the debt is being issued at a relatively reasonable temperature. Like a 10x is totally sustainable at the current size of the protocol. So it's all part of the process, to me at least.
I would also like to add some comments here. Like, first off, I feel like when we're talking about the ball having to decrease in value, like decrease in market cap to 9 million to match the current demand. Like, I just want to add a caveat that I don't think it's exactly just supply we're looking at, but it's supply plus non-bean liquidity. Like, when you talk about, I think when you were talking about, the effect of convert up on supply, you were referring that to taking bean out of circulation. But, that's just moving where the beans are held from the liquidity pool to the holder's hands. But, I think in order to increase the price through convert, what is actually happening is we were reducing the amount of non-bean in the liquidity pool. So I think thinking about, that this new metric we're discussing as a function of supply plus non-bean liquidity is a much more, is a way to think about it that showcases the problem, the problem much better. And then secondly, like, yeah, I mean, you are correct there in that. Yeah, I mean, right now it's like short-term demand can only come from speculation in the protocol, but this is why it's so important to figure out ways to drive real economic activity to Pinto. Like, once there's real economic activity to Pinto, there can be other spurs and catalysts for demand beyond just speculation. And this was one of the reasons why, the concept of nebula was originated, was from the fact that with Beanstalk, it was very clear that, you know, Beanstalk could only grow through speculative demand, and that was something that wasn't sustainable forever. And, Terra tried to create artificial demand through paying out some fixed yield, which, isn't sustainable in the long term. So, Nebula is exploring ways to actually bring real economic activity to Pinto, and, hopefully sometime this year that can be released. And by Q3 we can have, Q3, Q4 we can have people actually using Pinto for trading and economic activity instead of speculative demand. And, that can be an alternative catalyst to creating demand for Pinto beyond just future yield.
I mean, I would argue that the only demand for Pinto is always going to be from future yield. Like that. I mean, otherwise you might as well just use like
That's crazy. That's
if the
crazy.
risk
It's like
if the
the
risk
future
of
yield is part of it. Like I want to hold Pinto because I can earn yield and it's sufficiently low volatile. Like, sure, if you're only optimizing for stability, like go use USDC.
I would also say if you want something that's Leviathan free, like if you don't care about the properties of Leviathan free and you want stability, go use USDC. But I think there's been a lot of talk in the general community about how in the long term we really can't have an economy built on USDC because at that point there's no point in even using Leviathan free rails because the money itself that the economy is built on is not doesn't have the principles that crypto was created for originally. Like the whole purpose of creating Leviathan free money is so that we can, move our ecosystem out of a place where it is reliant on capturable monies, which goes against everything I personally feel like that Bitcoin was created for. So, I see USDC as a short-term evil, but we do need something that's scalable and can, potentially outcompete USDC to move people over. Like I'm totally of the mindset that, people aren't going to start using Leviathan free systems just because they are Leviathan free. We have to make Leviathan free systems competitive with non-Leviathan free systems, and we need to make them outcompete non-Leviathan free systems or Leviathan capturable systems in order for people to actually migrate. And what Pinto is trying to do is create a money that's not just Leviathan free, but also more scalable. And the hope is that once an economy starts to be built on top of Pinto, people will realize that the carrying costs of Pinto are significantly cheaper than that of others, and we will actually see, you know, people more willing to borrow Pinto because it's a cheaper thing to do than other coins. And this is one reason I'm particularly excited about turning the silo into some lending facility where it can actually, lend out Pinto at a rate that should, in theory, be lower than the rate at which people are able to lend out USDC because it's subsidized by the yield from the silo. And I think that's another thing that can help catalyze use case of Pinto as an actual currency with real economic activity happening. And I think it helps showcase the benefits of, why Pinto can outcompete USDC. So, I think it's not just about the fact that it's low volatility, but it's the fact that it's scalable and Leviathan free that helps it outcompete the, other low volatility currencies in the space. But, until it starts to be used, it can't showcase its properties of why it's better. And it should be noted that borrowing Pinto to lever up on other currencies actually doesn't have too much risk for the participant that's using it to lever up. Like what they're in essence doing is, say if someone wants to lever up on ETH by borrowing Pinto, like they are going short Pinto and long ETH. So, their risk is risk that Pinto will depeg to the upside, which is something I feel like people in this chat would be very happy about. So, people can actually go short Pinto and not have to take on peg risk of Pinto in order to go long other currencies, which I think is something that has real power at a rate that in theory should be cheaper than the rate of borrowing USDC, such that, this person has greater potential upside in the fact that if Pinto depegs, they actually, they're going short Pinto actually paid them out when they were really just trying to go long ETH. So, I feel like there's a lot of value in, using Pinto as a tool to provide other access to other financial activities, and it doesn't necessarily imply that other people are going to have to take on the peg risk of Pinto, as I think you were implying, Ford.
So are you saying that Pinto does not have any real economic use until that borrowing facility is created?
it has economic use right now, in the ability to be a provider of liquidity for, several assets on base. It's just, while liquidity levels are low and the AMM is inefficient, and the AMM is inefficient because integrating an AMM into Beanstalk is a very complicated thing. And, by having to have it be integrated into Pinto, we had to put severe limitations on the strength and quality of the AMM itself. And in its current state, the Pinto exchange is not competitive with the top order books that exist on the market. And so, therefore, as a tool for allowing people to exchange between currencies, it's not the best one out there. So, the value of Pinto as a tool for economic activity when it comes to trading is quite low right now. Economic activity consists of trading and then lending and borrowing. And by allowing people to lend and borrow through the silo, it opens up a new potential vector for economic activity to happen in Pinto by, doing something like creating a perpetuals market or prediction market through Nebula or another exchange on top of Pinto. It opens up another door for more economic activity to happen. It should be noted that a perpetuals exchange built on top of, something like wrapped Pinto or Pinto deposits, people can still go short Pinto in this instance to hedge their exposure to Pinto. So it isn't necessarily limited to just people who are willing to take on Pinto peg risk. But, in theory, the thought with these types of markets is that the silo yields will naturally allow trading perpetuals in Pinto to outcompete trading perpetuals not in Pinto, or trading prediction markets, in Pinto is more competitive than trading prediction markets not in Pinto. With prediction markets, a lot of the things you're holding are long term. And so, therefore, having that denominated in a yield bearing token allows you to actually capture yield from the perspective during the time period of when you place the bet to when, that actual prediction market settles. So, there's a lot of avenues for how economic activity can start to happen in Pinto. And there are reasons why, at least from my perspective, doing these things denominated in Pinto will outcompete doing these things denominated in USDC, irrespective from the fact that at any point in time, USDC can censor the entire market.
So one of the things that was mentioned was that the system is more scalable than any other system. And also, that it's Leviathan free. I would argue that the market cares more about money than about freedom, which is an unfortunate state of our society, but that seems to be the way that it is. And I think that is demonstrated by the recent success of tokens such as USDE, which are basically centralized tokens that hold a lot of their backing on centralized exchanges, which are totally censorable things. And yet we have seen massive success in these yield-bearing stablecoins, this category, as it were. There's also USDS, this usual, a couple of others, and all of them grew, in my opinion, because they had high yield. And I personally think the only way that Pinto is going to grow is also if it gets high yield. And so to some degree, we should try to let this cycle bottom out as soon as the faster we can make the cycle bottom out, then the faster we can start the upside as well, and the faster this will get a lot more attention on the next run up, because we have a number of different integrations like CoinGecko and DeFi Llama. People will be able to spectrate on future yields based on spectra. But again, all of this is basically, the only reason to hold the token outside of it being the censorship free is the yield. And so I really think that is one of the key selling points. And that's actually how I found out about the first iteration of this experiment, which was Beanstalk, was because it had good yield. And so I think over the long term, yes, the protocol needs to grow. And I do think it's possible that over the long term, this grows at a sustainable rate. But I guess the point I'm trying to make is we mentioned the idea of we shouldn't be doing any printing at all until we've passed through this $4 million barrier. And I would just say, like, the higher chance that there is that the protocol does a little bit of printing, the higher chance the protocol has of overall success. And therefore, having something like a 12-hour or even 24-hour convert down penalty in order to let the protocol breathe a little bit gives a much greater chance for the protocol surviving in the long run, because it has a higher chance of the protocol kickstarting the next growth cycle, as opposed to I would argue that it's better to print a little bit more in the next few weeks rather than let the protocol issue more and more debt over potentially a number of months, and that is a more likely way to get us back on the upswing. That's kind of how this whole topic originally started. But
Yeah, I mean, go ahead.
No, that's my main idea. I think you got it.
Cool. Yeah, I mean, I totally agree with you in the fact that the market does not value Leviathan-free systems. You can see that through the success of the tokens you mentioned, but also through the success of something like Hyperliquid that's closed source and has a very, very limited validator set. The market is willing to value like the open financial rails that the system gives and the lack of KYC that these systems require, despite the fact that they are capturable by Leviathans. And, I feel like the point I made was exactly in line with this by trying to explain how Pinto, in theory, should be more competitive as a tool for people to borrow and as a basis of future other types of markets. Now, in regard to your point about growing protocols, yeah, I mean, like something like the Athena USD token grew because of yields, because there was no financial activity happening in USDE. But at some point they realized that the growth that can come from yield is limited and decided to try to build a perpetual market on top of their stable coin as well, which I think their perpetuals markets are not the strongest. But it showcases that they also understand that at the end of the day, you do need financial activity to occur. In regards to your point about short-term growth, yeah, short-term growth would, lead to less debt being issued. And I am willing to accept that there is a potential path in the future where short-term growth actually sets the protocol up for greater success. Do I think it's necessary? No. Will it make the community more happy and grow faster in the short term? Yes. Is this beneficial? Probably. But, I don't think that's necessary. Do I think in the long term, convert down penalty is beneficial? I don't know. And, to me, it just feels a little weird to add something to the system that might, that feels like a bootstrapping tool to try to create yields now so the protocol can grow a little faster, when in the long term it's something we just might end up taking out. But, for the sake of experimentation, I feel like there is value in trying to test out what it looks like, but the risk is high. And yeah, I mean, it just feels like, I mean, would it reflect poorly to create some mechanism that we may end up taking out because we feel like the protocol is growing too fast with respect to the growth of liquidity? I don't know, but yeah, for the sake of experimentation's sake, I think it would definitely interesting to see how it behaves. I mean, it should be noted that originally there was no convert mechanism in the protocol, and it became very clear to the participants of the system that a convert system was better than no convert system. So the idea of going backwards a little and dampening the strength of the convert system, especially when converting down, I don't think there's a problem with that. But we're getting, it could potentially lead to the system growing too fast and not accruing liquidity fast enough, which is, an existential risk.
So after
But
how many
go ahead.
after how many hours do you think would be enough to kind of like let the system breathe, but then there should be no convert penalty after that?
I mean, that's a very hard thing to say. I mean, I feel like an absolute maximum of 8. I feel like I'd be comfortable at 4. Even more comfortable at 2. But yeah, I mean, it's very hard to see to understand what these dynamics will look like in play.
I have a call in 2 minutes, so I'm gonna have to hop. I just want to summarize where I'm at, which is I feel like my instinct, which was to try to make it clear that Ford Pinto is really advocating for the fact that we need yield, and without yield, nobody wants to use this thing. And I really push strongly back against that, vehemently so. Like the utility has to speak for itself, and the utility is not the yield as a guarantee. The utility is sufficiently low volatility while you receive a portion of seniorage, but the seniorage cannot be the thing itself. And as soon as we make that switch to, this is just a seniorage game, I think this sets the protocol up for an existential failure at some point, even if it grows faster. So there is a separate question as to whether or not, we can we smooth out the cycle? Can we, at the bottom of the cycle, instead of needing to issue another 15 million of debt or whatever of pods to clear another couple million of supply, instead of doing that, can we just print our way out of it? It's like maybe we can. I question whether or not we should, even if we can. And I would bet that we definitely can. I would bet all my money on the fact that we could definitely print our way out of this problem. But I question heavily whether we should. So that's sort of where I sit. I do have to hop. I already rescheduled this call once, so unfortunately going to have to hop. But excited to be having these types of discussions in the Discord.
Yes, thank you.
Peace out.